Dr.B.Arun Kumar, Associate Professor, Department of Minor Studies, K.B.N College, Vijayawada. Good morning once again. So my present topic is regarding the accounting principles, including accounting concepts and conventions. So everyone, as a beginner in the accounting subjects, every accountant should have to know these concepts and conventions. Even this is useful for BCom students, BBA students, MCom students, MBA students. So those are specialized in accounting, finance and investment. This knowledge will help them. Okay, next going to the concept. What I'm going to teach today. Accounting principles, accounting concepts, conventions, and how these concepts and conventions are applying in the preparation of financial statements. Of course, earlier many videos were there, but this applicability is very important. Only learning the concepts from exam point of view is not enough. To face different interviews, we need the applicability of these concepts in practical, how they are. So when coming to the accounting concepts and conventions, so these are the two categories of the accounting principles. So what is the meaning of the accounting concepts? Accounting concepts referred as conditions which must be followed by the accountants in preparation of the accounting statements. Yes, every accountant should follow these concepts. If they don't follow, it will report mismanipulate. Is considered as a mismanipulation of accounting statements. While coming to the accounting conventions point of view, they are referred as the traditions or circumstances which may or may not be followed by the accountant. They only act as a guidelines referring points in preparation of the accounting statements. So the difference between these two are accounting concepts must be followed by the accountant, but accounting conventions may or may not. Okay, what are these accounting concepts and conventions? So broadly speaking, there are 10 concepts and 4 conventions. What are these concepts? Business entity concept, money measurement concept, going concern concept, dual aspect concept, matching concept, cost concept, accounting period concept, objective evidence concept, realization concept, and accrual concept. Accounting conventions are 4. Full disclosure, the convention of full disclosure, convention of conservatism, then convention of consistency, and convention of materiality. Concept. While coming to the discussion of each and every one, we will start with the business entity concept. This concept says that business is a separate legal entity. It is considered as a separate legal entity. Business is considered as a separate legal entity which can manage its own assets and liabilities. And creditors who supplied are treated as a owners are treated as a creditors who supplied the capital to the firm. So business is separate entity and owners are treated as a creditors. This is a major concept. So as per this concept, the liability of the owners, here the owner means equity shareholders. The liability of the equity shareholders, that is the owners, is limited only to their capital contribution. Only to their capital contribution. The further losses, there is no relationship with the owners. They are not responsible for that. But in case of sole trade and partnership, the owners are personal assets also liable to pay the business losses. But here, the owner personal assets are not liable to pay the business losses as per this concept. Okay. Coming to the second concept, Money measurement concept. As per these concepts, accounting books records only business transactions that can be measured in terms of money. That is monetary transactions. Books of accounts records only monetary transactions, and it ignores the non-monetary transactions even though they affect the business. For example, monetary transactions, sales we are measuring in lakhs or thousands or crores. Expenditure we are measuring, salaries measuring, rent measuring, land worth is measuring. That's why we are recording in the books. But there are some non-monetary transactions which may affect the business, but we are not recording. I will say one example for that. There is a conflict between the production manager and the sales manager. A sales manager, he brought some targets to the firm and orders, sales orders, but production manager intentionally he reduced the production, timely not supplied the targeted product to the customers. As a result, company profits are decreased. It could not reach its targets. So it affected business negatively. Even though we can't write this much of decrease in sales or in profits or revenue caused by the conflict between the production manager and sales manager. So these are non-monetary transactions. We can't measure. So these type of transactions we are ignoring in books of accounts even though they affect the business. While coming to the next concept, third concept is a going concern concept. This concept says that life of the business is infinite. A business unit is considered as going concern but not as a gone concern. Why? Every business people start with a business that it will be continued in the business. Generally, do you start any business with a period of 6 months, 1 year, 2 years? No, it is not a business. It is just a joint venture. Okay. So while this, as per this concept, in balance sheet, assets are categorized as a current assets and non-current assets. Separate treatment will be done according to this concept. So entire balance sheet is prepared based on this concept. Coming to the dual aspect point, this is the fourth one. This concept says that every business transaction has two aspects. One is benefit giving aspect, another is benefit receiving aspect. One should be debit, another should be credit with equal amount. Applicable. This is the heart of entire double entry system of accounting. The entire double entry system of accounting is prepared based on this concept. The next one is matching concept. As per this concept, company expenditure is matched with the company revenue. Find out the profitability of the business operations. If expenditure greater than revenue, it is considered as a loss. If expenditure is less than the revenue, it is considered as a profit. So this concept is very useful in preparation of profit and loss statement. Entire profit and loss statement is prepared based on this concept. Okay. While coming to the next concept, cost concept. This concept says that fixed and non-current assets should be recorded in accounts at its cost price or book value. The book value is nothing but the original cost of an asset minus every year depreciation. Every year depreciation. So every non-current assets in balance sheet will record at its book value. It will show the book value. So as given this applicability in balance sheet, fixed assets record at book value. And coming to the accounting concept, periodic concept. So according to this concept, accounting reports should be prepared in regular intervals, and time period should not be too long or too short. Applicability. So according to this concept, accounting reports are prepared quarterly, half yearly, semi-annual and annual. Next, objective evidence concept. This is the another concept, that is object evidence concept. This concept says that whatever the business transactions recorded in books of accounts should be supported by an evidence. For examples, we are recording sales and purchases. We have the vouchers, invoices, all are act as a evidence. A land of the company, we have the documents and physical inspection of other assets also. Coming to the realization and accrual concept, these are the interrelated concepts. These are the concept that deals with the recognition of revenue and expenditure in accounting period. They are based on the realization and expiration concept. As per the realization concept, it deals with the revenue recognition. Revenue should be considered as earned when sales are realized. Realized means goods are transferred, the date or the day on which goods are transferred, irrespective of whether money received or not. For example, the company has received a sales order on March 1st. Goods are transferred on April 1st. And money is received on May 1st. So, as per this concept, sales should be considered as revenue should be considered as earned on April 1st, not March 1st, not May 1st. So, when the goods are transferred, then revenue is generated as per this concept. Whether the amount is issued or not, future we don't know. Why? Because in accounting we are following, in our business we are following mercantile system. Means we included both cash transactions and credit transactions. Of course, 90% of present business transactions are on credit basis. Very less are on cash basis. That's why when the goods are transferred on the date, we have to consider the revenue is earned. And next, the expenditure point of view. Expenditure should be considered as incurred in that accounting period when the benefits are enjoyed. I will explain you one example that an employee was worked in the months of January, February, March, but we paid salary in June month. Company has not paid January, February, March salaries. They paid in June. So how to record these salaries? So here two accounting periods are there. Generally, one accounting period is completed by March 31st. April 1st onwards, a new accounting period will start. So as per this concept, these outstanding salaries should be added to the previous year salaries, previous year accounting period. That's why we add the outstanding salaries in the previous year salaries heading, in the previous year statements. They should not carry to the next year because the benefits of these 3 months are enjoyed in previous accounting period. The company enjoyed the benefits of services of the employees in previous accounting period, January, February, March. So salaries according to this year should be considered as last year expenditure, not this year expenditure. So these are the major 10 concepts, and 4 conventions also there. That is full disclosure, convention of full disclosure, convention of conservatism, and convention of consistency, and finally convention of materiality. The convention of full disclosure says that All the financial information that will affect the decision of the stakeholders should be given in the financial reports. Financial information affect the stakeholders decisions. Stakeholders means investors, owners, managers, employees, customers, all they will take decisions based on this information. So the information which will affect the decision of these stakeholders should be given in the companies. For example, treatment of contingent liabilities. On a company has purchased a land 1 year back, but a person filed a case that land belongs to him. Company was cheated by someone. This case is in court. How to treat this land as an asset or liability? We don't know. We have to wait until the court judgment. But until then, we have to show this land as an asset in asset side of the balance sheet, and we have to give a note on the below of the balance sheet, that is under the heading of contingent liabilities, as the worth of land 1 or 2 crores, it is in the court. The land worth of 1 or 2 crores, it is in the court cases. We don't know whether it will be liable or asset in the future. Uncertainty. This transaction included uncertainty. Okay. Next, coming to the accounting convention. Conservatism. Convention of conservatism or prudency. It works like a risk-proof jacket. How? This, as per this conservatism, it is clearly saying that no anticipated profits, but provision for losses. So any company should not record the future profits that we will earn this much, that much, but you can prepare a provision for future losses, doubtful debts, provision for doubtful debts, provision for bad debts, like that. So that's why this is called as a risk-proof jacket to the business against the future losses. And consistency. Next one is a convention of consistency. This convention says that whatever the accounting policies, materials, techniques prepared by the accountant should be consistent for certain period of time, which means that accounting policies, procedures, techniques, methods should not change every year. We have to follow them for certain period of time. That will increase the reliability by the stakeholders on the accounting statements. For example, LIFO method, FIFO method. Last year, accountant used FIFO method. This year and next year or 2 years, we have to follow the same method. If you change to the new method, this year, the result will be different compared to previous year. So, which are very difficult to understand. That will reduce the reliability. And final convention is materiality. This convention says that the dealing of a transaction as an asset or expenditure is subject to the amount involved in the transaction. For example, a company has purchased a land, it is considered a fixed asset. Machinery as a fixed asset. But a company purchased a pen, it is considered as an expenditure. Why? Because the cost of the pen is 10 rupees. Life of the asset is 5 days, 10 days or 1 week. But the land and machinery value is long run. It involves the huge amount, lakhs, crores of rupees. So that's why the amount of involved in the transaction is subject to the materiality. So finally we discussed these 10 concepts and conventions in preparation of accounting statements which are useful to the accountant. Everybody, thank you.